Did you know there's a long-term discernible pattern hidden within the VIX indicator? We're going to show you what this means for today's markets, and after looking at the data, one particular area of concern. Of course, we're referring to the VIX index, the Chicago Board of Options and Exchange Volatility Index. It uses the near-term expiring options on the S&P 500. Those premiums predict volatility over the next 30 days. It's also known as the fear gauge. Essentially, when stock markets go up, traders don't use options as much. But when stocks get shaky, they'll use options. The use of those options raises premiums, and the rising premium sends the VIX higher. So the VIX goes up when stocks go down. Now, the VIX cycle. What is the average price of the VIX every day of the year using over 30 years of data? Essentially, you wanted to find out what's the average price of the VIX on January 1st, every single January 1st, going back 30 years, January 2nd, so on and so forth. Well, we've done this. Putting the averages all together, this line shows us the average value of the VIX for every day of the year using, again, over 30 years of data. And what we can see is very interesting. We hit a peak. The first peak we hit is in March of every single year, we should say. That's around the VIX 21. We then see a slide to the downside in the VIX. Now, again, when the VIX goes down, it means stocks are strong. So if we see the VIX on the opposite, upside down point of view, stocks tend to get weak coming into March, and then they strengthen. They strengthen as the VIX goes down, hitting levels around 17 on average. Now, we do see VIX readings lower than 17 or higher than 21. Again, these are average readings. In July, we tend to see the bottom of the VIX, meaning the strongest stocks tend to occur during the earnings season in July. We then see a reversal. The VIX starts to climb from July on up, hitting peaks in October. No big surprise. We know September and October tend to be very shaky months for the market. And then we see the stock market return to the upside as the VIX declines from October through the end of the year. The VIX begins to go down. So we see strong stock markets from March through July, and again from October through the end of the year. We tend to see weak stock markets coming up to March, and then again from July through October. Very interesting cycle. The reason why this is so interesting is because stocks tend to go up over time and the components, and the S&P 500 will change, but the VIX is a very objective way of looking at the volatility over many years. Now, here we see the blue line is the average VIX, what we just looked at, but we imposed on this year's current VIX. What did the VIX reading show us January 1st, 2024 through present day? That's in yellow. And in particular, what you'll notice, first of all, that huge spike to the upside, 38.6. That was that big scare we had just about a month ago with the Bank of Japan and the very, very sharp sell-off to the downside. That was, pretty unprecedented. That was far greater than the average value of the VIX. But we also know, remember our averages, from July through October, we tend to see a rise in the VIX. We see that with the blue line going up. Current levels are 21.3 on the VIX, which is a little bit above that average. This is important. We're going to tell you in just a moment why that actually is so important. That could be a game changer. Now, the average VIX, generally speaking, we took a look at the data. The average VIX is lower when interest rates are higher than 3%. We took a look at 30 years of data and said, okay, show me the average VIX when interest rates are below 3% and the average VIX when interest rates are above 3%. Generally speaking, again, the VIX tends to be lower when interest rates are higher. That makes sense. When interest rates are higher, that tends to correlate with strong stocks. When stocks go up, the VIX goes down. Stocks are stronger when interest rates are higher, generally speaking. Now, of course, stock market crashes also occur after a period of very high interest rates. So it's not an absolute truth where we can just buy the stock market as long as we're above 3% interest rates. Now here, really interesting. The white line in the center, that's the average VIX that we've been talking about. The blue line shows us the average VIX only when Fed funds, meaning interest rates, are below 3%. The red line when interest rates are above 3%. Now, we can see here, generally speaking, the blue line is above all the other lines, meaning that the VIX is higher. Again, when the VIX goes up, means stocks go down. So the VIX is higher when interest rates are lower. The VIX is lower when interest rates are higher. Again, we tend to see high interest rates during strong economies and strong stock markets. In 2008, the VIX was significantly higher than its average. No big surprise here. In blue, that's the VIX for 2008. In red, that's the average VIX, averaging 30 years of data. And we can see September, October, November, that huge stock market crash correlated with that huge spike of the VIX. The blue line goes well above the red line. No big surprise here. But what's really interesting, look at the VIX before the crash. The VIX broke above its historical average in mid-July 2007. So, of course, 2008, we know those were very bad stock markets. 2007, though, the stock market was quite strong. And we see what happened here in blue. The VIX in mid-July, August of 2007 crossed above the red line. The red line is our average VIX over 30 years of data. So, and also, it's important to keep in mind, remember, July, August, September, October, we tend to see on average a rising VIX. But despite that uptrend, that historical uptrend, the 2007 VIX still broke above. Now, just looking at the stock market in 2007, we would have said, hey, stocks look strong. But looking at the VIX, superimposing this over its historical average, we would have seen maybe there's trouble on the horizon. We should be very careful during periods of time when the VIX is higher than its historical average. Well, you may ask, where are we now? We're above our historical average. The VIX currently is at 21.3. That's just a little bit above the historical average. It's not difficult to see that when the VIX crosses above its historical average, that could be a sign of trouble. What are the levels we should watch for? Generally speaking, we see an average VIX low around 17, the high around 21, 22. So if we start to see VIX in the 20s, 22, 25 especially, we should be very wary, especially because we are in a danger season. The danger season is July, the end of July through October. Now, the average VIX, again, we're in an uptrend right now. Again, that's the danger zone. That's when we tend to see the most significant stock market crashes. So we should be aware of that. Generally speaking, again, we tend to see higher VIX levels around this area, but if it's above the average, that's an area of concern. Now, a reminder, we spoke about this the other day. The outlook just got worse according to three key developments. We took a look the other day at jobs, the Fed, including Fed funds futures, and the bond market. We had the JOLTS report. It showed a significant drop in the amount of hirings and the amount of job openings that we see out there. We took a look at the Fed funds futures, which have now all of a sudden ratcheted up to the expectation of a 50 basis point cut in November. We weren't looking at that before. And the bond market, well, the 210 bond yield curve, that's doing something it hasn't done in a long time. We'll post a link up here as well. I think you'll find what we discovered here to be quite interesting. We hope this has been helpful. We look forward to seeing you back soon.